In this video, traders, we're going to look at the triple gap pattern. Stay tuned. Hey guys, warm welcome to you. All right, so we're going to look at the triple gap pattern, a nice pattern for potentially spotting trade reversals. Okay, so before I continue, I want to thank you guys if you're subscribed to the channel. Appreciate your support and your comments and questions, likes, dislikes, all that kind of stuff. Any of that is much appreciated. Thank you. So with that being said, let's move on to the triple gap pattern, which is quite a nice way of looking for reversals. Now, one caveat is this: we don't see this very, very often, but when we see it, it's worth paying attention to because it makes sense. Let's explain. So the idea of this is we have three kind of gaps to the upside. So we've got our first gap here, our second gap here, and then maybe our third gap here. That's probably, let's just do it correctly there, just to be sure that we've actually got a gap. So we've got three gaps. Generally the first one's going to be the largest. That's the key part of it. And often maybe we've got a spike in volume down here, a catalyst from earnings, some reason why this has gapped up significantly, some sort of news, etc. Then day two, again, we've closed at highs on one, we've gapped up again, so bulls fully in control. They've decided to gap it up even more. Maybe there's some more news flow coming out. Maybe it's one of those macro news events that's causing the cash index to gap up. I've seen this a few times throughout my years where we've had kind of news flow coming out. And then a third day of gaps. You've got a second day, you've got a third day. Again, good strong move, gapped up. So we've had 3 days of gap. Pretty much obviously why it's the triple gap pattern. But we've had 3 days of gap, good solid demand coming in. Of course, we can flip it on its head and it could be to the downside, but obviously just change all these the other way around and it would be supply coming in. So the theory of this, guys, is that it's a too much too soon trade. It's a mean reversion trade that may say, okay, it may not be a precursor for a full-scale reversal, but it might be decent enough to have a little nibble to the downside for the spring to contract. You know, as traders, we like to watch that spring, get on the end of that spring. When it contracts, we're out of the deal, forget about what's happened last time. That's one of those things. Price has pushed up very quickly, very dramatically with the gaps as well. Trapped a lot of shorts, encouraged a lot of longs. You probably get a lot of people thinking this is going to go to the moon. And this quick move really starts to exhibit exhaustion. So I've added here this candle where we've taken out the high and rejected because I think that happens more often than not. You know, the next day we've kind of opened up in the middle of the range, not as powerful. Maybe it pushes back up, so it's still strong. But then it's the first day where we don't see strength. The first day we don't kind of push up to clear highs. It's adding some doubt into people. And don't forget, if you're here, you've bought here, you've seen that, you're very pleased. And so you don't want to see that those gains go away. Shorts also are thinking, well, you know, I'm really hurting. So there's a lot of people who are, you know, are really thinking, okay, this is kind of it now. We're going to roll over and we're going to do okay. And that's really the whole premise of it. After those 3 gaps up, we've got a lot of people who, especially longs, who want to get out, and shorts who are thinking, well, you know what, I'm hurting, but if this is going to reverse, I can afford to just get a much better entry and average my entry into it. So then we get this candle here, and really the entry obviously is on the short side entry, but the entry is, I think, some people may say it was super aggressive, but for me, if you do get that, it's worth a nibble. And if you see why, right? You get your high put in, and let's say you close at highs. Next day you open up. Okay, we open here, and then we push up again and fail. Your risk is quite limited. And yes, I get it that you may well get stopped out. It might have a couple of goes up there intraday before it closes, but the point is that's a very low risk for ultimately bringing back even kind of a third of that gap. So for me, that's not bad because it really does ramp up the risk reward ratio. Even if you don't decide to do that and you decide to do it on the close of here, you've still got a pretty reasonable, if that was our stop loss, it's still pretty reasonable compared to what we've got. And yes, okay, this chart may not be like that, but the point is the first red day, the first sign of weakness is a time to add some other strategy into it and say, okay, well, I might get short on the close here with a stop above the high. I might get short on a reversal intraday as it comes through that high. I might kind of wait for the next day to see where we are. The point is, once you've had those 3 gaps up and you've seen some weakness, because don't forget, guys, if you get a 4th and a 5th, you don't take the trade. If it's gapping up again, just don't take it. If it's not and exhibiting some weakness like this candle is, whatever that may be, whether it is that, whether it is a solid red, however it comes out, then you can say, right, there's some interest there on the short side. I will have a go because this is exhausted. The buyers are well and truly flushed out of it, and we could get some sort of retracement. I'd be cautious about having a full retracement unless, of course, there was some bearish news that kind of negated all this and you were lucky enough to get a good short entry there, then fine. If this is some sort of, from a company perspective, if this is some sort of company changing news that's significantly bullish, I'd be cautious about trying to push too aggressively for this, because we may well test again to highs as more money comes in and we get some higher time frames pushing the throttle a little bit harder. But for an unwinding, for a retracement, for a kind of 4 or 5 day counter trend move, then taking that extreme exhaustion and hitting on the short side seems to me, if you can quantify the risk with a decent risk reward ratio like you can with this kind of stuff, seems to me like not a bad trading strategy. All right guys, that is the triple gap pattern. Take care, see you next one, keep your risk managed. Bye bye.